Alrighty, let's go ahead and get going. I'm going to start us off this morning with our collect for the second Sunday of Easter, which is a beautiful collect. It's one of my favorites. So let us pray. Almighty and everlasting God, who in the Paschal mystery established the new covenant of reconciliation, grant that all who have been reborn into the fellowship of Christ's body may show forth in their lives what they profess by their faith through Jesus Christ our Lord, who lives and reigns with you and the Holy Spirit, one God, forever and ever. Amen. Well, again, good morning. It's great to see you. I wanted to focus us this morning on an aspect which I'm not sure, how many of you are aware of, or if you're aware of it, may know that it is maybe more applicable to us than we previously thought, and that's the employee retention tax credit. And for those of you who I can see, if you can just kind of show me by raise of hand visually, if you're aware of this or have looked into it at all. Okay, so that's good. Looks like it's a good topic for conversation. Um, and Charles, I'll count on you to kind of, double check me maybe on some of the things that I've got up here in my my slideshow, just in case I happen to go off track. So with that, I will get started sharing my screen. All right, there we go. So the employee retention tax credit is something that has been around ever since last year, but the reason that it's become an issue now is because some of the more recent tax law changes or relief changes have significantly changed it from what it was last year. So as I mentioned, it did first come into existence with the CARES Act last March, over a year ago now. How hard is that to believe, right? And that at that time there were some significant restrictions on it. Most principally, the one that said that if you applied, it basically limited you to having to choose, excuse me, between the PPP loan and the employee tax retention credit. If you took one, you couldn't take the other. And for the vast majority of us, the PPP loan was much more beneficial. So we sort of pushed the employee tax retention credit off to the side and didn't think about it much anymore. And then all of a sudden in December of last year, with the what they call the Relief Act for short, it expanded the availability of this and extended its availability through June 30th of this year. And when I say it expanded the availability of it, the principal expansion had to do with the fact that the PPP loans and the ERC were no longer mutually exclusive. You can do both. However, you can't use the same wages to qualify for both. Because of some of the limitations on covered periods and things like that, that means that there are still wages available to us, qualifying wages. And when I say wages, as you'll see later, that also includes healthcare costs that were probably outside of what we decided our covered periods would be, that we could still use for the ERC. And it also made it retroactive through March 31st of, back to, I guess I should say, March 31st of 2020. So that means we can go back and look and see if we have opportunity to qualify for this credit for some of the wages and healthcare costs we did not use for PPP forgiveness purposes. And then finally, the ARP Act, which was most recently enacted March 11th of this year, extended the ERC through December 31st of 2021. And they're still coming out with, with guidance on whatever changes they may have tweaked as far as that's concerned. So that's really where all this originated and came from. And so this will go back through some of the things that I just, mentioned. Then, as I mentioned, if you didn't consider the ERC in 2020, or, weren't eligible because you took a PPP loan, that our retroactive ability to benefit from both PPP loans and this credit really is a significant reason to consider the ERC, to go through the calculations and, the work that it would take to go back retroactively to claim the credit. And then, again, looking ahead in 2021, the one of the other things that the Relief Act did was enhance the amount of the credit. It actually increased from what it was in 2020, and so we'll see that as we kind of go through some of our examples here. So, the first question that I wanted to go back to, just in case there was any question about this, is that it is very clear that churches are eligible for the ERC. And you'll see, down at the bottom here, I've got my source, which is linked. So when this slideshow goes up on the website, the presentation goes up on the website, you'll have an opportunity to, go straight to this. And if you want to go back to that source material, you can feel free to do that. But it is very clear, because you'll see in a lot of this stuff, if you do your own research on the ERC, the language is all about trade or business operations, which, the first thing that comes to our mind is, well, we're not a trade or business, so we always look for that clarification that, yes, churches are eligible. And we have that clarification. It all goes all the way back into the acts and the IRS regs that interpret them, if you want to go back that far and dig it up and look for it. But this BDO is actually a very well-known nonprofit. Well, they're very well-known accounting firm, and this comes from their nonprofit and education practice within that firm. So this is authoritative reference that we're looking at here. And so a little bit more in depth about what is the ERC. It's a refundable payroll tax credit. What does refundable mean? Refundable means that if you don't have enough payroll taxes to offset the amount of the credit that you calculate for yourself, that excess of the credit can actually be refunded to you even after you apply it against your payroll taxes. That's what a refundable credit is all about. And it's for wages paid, and this emphasis is mine, and health coverage. So we don't want to forget that, because that's pretty significant for lots of us. Provided by an employer whose operations were either fully or partially suspended due to a COVID-19 related governmental order. Sound familiar to any of you? Or that experienced a significant reduction in gross receipts. So those are two separate criteria that you can use, and they may differ for any church in our diocese, depending upon where you think you would most reasonably fall under that criteria. Again, going a little bit more, digging a little bit more in depth there. The language in more specificity says that to claim the ERC in any given calendar quarter, that nonprofit organizations, and that includes churches, must meet one of the following criteria during that quarter, not both of them, just one of them. The first one, obviously, is the most, clear-cut one. Under any congregation's particular facts and circumstances, you can meet it. And that says your operations were fully or partially suspended as a result of orders from a governmental authority limiting commerce, travel, or group meetings due to COVID-19. Okay, now on the surface, that would seem to describe a lot of us, because we know that our operations were not fully suspended. We've been doing online worship. We've been making do with the things that we can do. So the question comes, what does it mean to be partially suspended? So we'll go into that in a little bit more detail. This is coming from a different source because I needed to dig a little bit deeper, and I found this to be a little bit more relevant, and gave some helpful examples. So it says that certain, again, it says businesses, read churches, may be indirectly affected by a governmental order, although they are allowed to operate. It depends on whether the suspended activities make up more than a nominal portion of the business. Okay, so now we have to dig a little bit deeper and say, what does nominal mean? Okay, and in questions 11 and 18 of notice 2021-20, which I have, again, at the end of this, I'll go through my sources, and they're linked also. And notice 2021-20 is one of them. The IRS references nominal to be either less than 10% of either the total gross receipts of the business operations or the total hours of service performed by all employees. So if the suspension of certain types of activities in your congregation means that you were impacted either more than 10% of your income, or to the in excess of 10% of the hours of service performed by all your employees. Okay, so that could be a combination of your sexton, your music director, obviously your priest. If the total hours of service that they performed were impacted more than 10%, then that would be considered to be more than nominally. And I really, in most cases, I think congregations could substantiate this. Maybe in both cases, it could be both gross receipts, and because gross receipts includes your, building revenue, your fundraising revenue, in addition to your pledges and plate. So, I think for a lot of us, this will not be too high of a bar to be able to meet. And they give a couple of examples here that I thought were, that were sort of helpful to, really kind of give us a good perspective on this. They give, an example here where a food processing plant, just by virtue of the fact that they have to close several hours a day to clean due to enforced health regulations, that qualifies as a partial suspension. Okay. And then they give an example of a hospital that does remain open but couldn't perform elective surgery. That qualifies as a partial suspension. So the fact that we have remained open and, but perhaps have had to really curtail any other activities besides online worship does not disqualify us. We can still qualify as having a partial suspension. So again, that's for each congregation on their own to consider. What have you been able to continue to do, and what have you had to suspend, and to come to your own comfort level as to whether that constitutes a partial suspension for you. And, again, I have these links to the sources as well as to the IRS notice. If you want, there are many more examples in there than just the two that I've quoted. If you want to get a little bit of a better idea, if you need that for your own comfort level. And I noted that here. And so it basically reiterating what I just said, everybody's situation is unique. And you need to be comfortable with your own facts and circumstances about your qualification criteria. So then if you can't get comfortable with considering yourself partially suspended due to government order, the one thing I will also add is that it should be clear to all of us that the governmental orders that required us to, reduce our capacity for in-person worship, and for a time even to just go completely to online worship. That part we have no question about. Those orders came from the governor, and so the fact that we are responding to governmental orders to be, suspended or partially suspended is not in question. It's just, the degree to which that has impacted your activities being above a nominal degree. So that's really what you're looking for. If for any reason you either aren't comfortable with that or you want even more assurance, there is a second level criteria, which has to do with, again, specifically comparing gross receipts from calendar quarters in 2019 to 2020, and then 2019 to 2021 when you get into the 2021 regulations. And so for 2020, the rules say that gross receipts for any 2020 quarter that showed a decline of more than 50% is also a criteria for eligibility when you compare it to the same 2019 quarter. And that's so any quarter when that happened to you, and we kind of used to comparing our revenues now because we had to do that for PPP, although the percentage was different. Any quarter in which that happened is sort of the start of the period of eligibility. And then your period of eligibility continues until the quarter, through the quarter in 2020, where gross receipts once again became greater than 80% of gross receipts in the same 2019 quarter. Okay, so it continues through the end of that quarter. So it ends at the end of a quarter. If you in that quarter in 2020, where your gross receipts became greater than 80% of the gross receipts in the same 2019 quarter, you're still eligible in that quarter. So if it was the third quarter of 2020 or maybe the fourth quarter of 2020, you're still eligible through the end of that quarter. But only up until the end of that quarter. The following quarter, you become ineligible. So from the period of time that you became eligible to the period of time that you ceased to be eligible is the period during which you can claim the ERC. So there's always that second criteria. And in answer to your question, Sharon, about the monies received from the diocese. If you are receiving money from the diocese for operating purposes, they are included in your gross receipts. That would be something that would be included. And let's see, then moving on. For 2021, the gross receipts eligibility threshold got reduced. So it's no longer a 50% decline. Now you're only looking for a 20% decline, and you're still comparing against the quarters in 2019. Okay, so in the first quarter of 2021, you'd be comparing it to the first quarter of 2019. So on, so there is also what they call a safe harbor, which also allows you to compare your prior quarter's gross receipts compared to the same quarter in 2019. So if you're in right now, for example, we're in the second quarter of 2021. Okay, and if your second quarter, actually, if your first quarter 2021 gross receipts showed only a 20% or more decline from your first quarter of 2019, then you could still be eligible, as well as if your second quarter receipts still did that. And so in answer to your question, John, if the gross receipt is not met, the suspension of activity still qualify us. Yes, if you qualify, that's why I use that suspension of activities as a first qualifier. If you qualify under that, you don't even need to go into the gross receipts test. Okay, the gross receipts test is only if you're not comfortable that you qualified under suspension of activities or if you're looking for a little bit of extra, backup or reassurance. So,
I mean, we've completely lost our building revenue, which probably comes close to meeting those financial requirements.
yep, I'm sure. I mean, I feel like in your case, you've got a double case.
Okay.
Because you're clearly your activities were suspended to a more than nominal. It's more than 10%.
Yeah.
And not only on the revenue side, but I'm sure all of the activities of your priest, or in your case, your interim, and your sexton, and everybody else that was related to those, activities have also been curtailed to a more than nominal degree. So I really feel like I feel like you wouldn't really need to worry too much. I think you've got it covered on both counts. Okay, so then we move on to how do I claim it? Okay, so the employee retention credit can be claimed quarterly, and you can it's a number of different levels. Okay, you can first and foremost use, once you've calculated your employee retention credits, you can actually use them to offset federal payroll tax deposits. So like looking at us now in the second quarter, obviously for the quarters that have already passed, we can't do that because we already made those deposits. But for the current quarter that we're in, and then the third quarter and the fourth quarter, that would be probably your first thing that you could do so that you could be saving yourself some cash flow, is just use the credits to offset your federal payroll tax deposits, which include the employee FICA in the case of employees who have that withheld, and income tax withholding. So again, here we have a real benefit, because one of the things that normally is a limiting factor for us is that our priests don't have FICA withheld. So there's not a whole heck of a lot there to play with, but a lot of them do have income tax withheld. So you can use this credit to offset, your federal payroll tax deposits for both your lay employees' FICA withholdings and income tax withholdings, and your priest's income tax withholdings if they have them, taken. And so that's the first way that you can do it. And then you can also, if you don't elect to actually reduce your federal payroll tax deposits, you can also claim the credit on your 941 form. And so, again, if you, for the part of this second quarter for which you may have already made a payroll tax deposit, you'll still have an opportunity when you file your 941 form to use the credit to offset anything that you might have missed there that wasn't already used up by your other payroll tax deposits that you have yet to make. So those are the first two ways in the current period to be able to do that. Now we also have, obviously we have these retroactive periods. And I do need to remind you that into 2020, it only goes retroactive to basically, I think it was, I have to double check the date again. It was definitely in March. It might have been something really odd, like March 12th or something like that. So whether you want to go back into the first quarter and amend your 941 may be up, maybe kind of up in the air, but definitely the second, third, and fourth quarters of 2020, once you calculate the amounts of the credit that you would be due, you can go back and amend your 941 returns and get refunds. And as I mentioned, to the extent that the amended 941s don't use up your credit, it's still refundable to you. And all of this works through your 941 forms, which also means obviously that it's a coordination with your payroll tax company if you have one. And it's also worthy to note, as I have here on the slide, that the employee retention credit can be claimed up to 3 years from the date in which your quarterly payroll return was filed. So you have that long to be able to amend your returns and claim this credit. So it gives you some time, because there's some calculations, involved here that you're going to have to be paying attention to. As Amanda noted in the chat, they use paychecks. Whoever your payroll processing is, you're going to have to, first of all, go through the calculations and then be in contact with them to coordinate, how you do the amended filings and then the filings moving forward. That's how you would need to do that. And then one of the other interesting parts about this, and Meredith, I'll get to you in just a second, is that small eligible employers, and we are small employers, we're under, it used to be in 2020 was 100 employees and under was considered to be small. Now in 2021, they've even upped that to 500. So we're clearly small employers. Can actually request advance payment of the credit, subject to some limits, on a Form 7200 if you really feel like you need that. But you have to reduce your employment tax deposits first, before you can do that. That's really, I think, for people who, are experiencing real extreme hardship and need that money. They know they're due the money, but, for cash flow purposes, they need it quickly. So yeah, Meredith, what was your question?
We also use paychecks for our payroll.
Mm-hmm.
So in January, I had COVID and they reported that to them and they gave me some kind of special COVID pay. Right after that, the payroll journal that came from paychecks was not matching what they were taking out of the bank. So it took me several pay periods to kind of figure out what was going on. And finally, when I got a hold of them, they said it was something that we needed to do on our end. So in other words, they would report that they took $145 out for taxes. There's three things that they go and take out of your bank: the direct deposit, their fee, and then the taxes. So the taxes suddenly went from $145 to $12.42. So my concern is I'm inputting $12.42 into QuickBooks to make for the treasurer, but my general ledger from Paychecks is saying $145. So I reached out to them and they told me that I had $1,000 COVID tax credit. No, they didn't tell me that. They told me to get a hold of an accountant. They weren't sure why that was happening. And right. And our
so they did it, but they're not sure why it was happening.
Right. She said, we said, why are you continuing to do this? It only affected one employee in January. So we reached out to our wonderful affiliated church, to the treasurer there, who's a CPA, and he looked into it and he told us we have $1,000 COVID credit. When we use it up on the tax side, it'll go back to what it was. So last week it reverted and it went back to $145. Do we need to report that somewhere?
Well, maybe you and I need to talk about that offline, because that doesn't sound like this credit, although it might be. And then we can kind of figure out, because it definitely sounds like what they did is they put you into some kind of a special wage classification that they should have just left you alone, but if they did, it could be. There's a couple of other acts that we don't talk a lot about, because the Families First Coronavirus Protection Act that involves some of these other types of credits and wage types that we don't talk a lot about, because with all of the other stuff that we're doing that really does apply to us, it's, you have to be careful about, as we've seen, what coordinates with what. So let's talk a little bit more specifically about where that credit's coming from, because if we need to talk with your payroll company and have them reverse that and make your wages just normal wages again, and have you, have the additional tax, but then be eligible for this credit, we may need to do that. So, but I don't know. We have to find out a little bit more specific information.
All right. I'm sorry to sidetrack everybody.
Oh, no, that's okay. I'm glad you asked the question. I'm glad you asked the question. Just make sure that we get a chance to, follow up, after this individually, to figure out what that's all about.
Okay.
Thanks. Okay, so again, moving on to the coordination with the PPP, as I mentioned, one of the most favorable provisions in the law is that you can now have received PPP loans and forgiveness and claim the ERC. Okay, so that was something that was not permitted last year. And as I mentioned, we are amongst those organizations that turned more to the PPP loans because they were more beneficial for us. But now we can do both. And I was right, March 12th. How about that? That's a little scary. You could, so that coordination goes back to March 12th, which means that you could theoretically go back and amend your first quarter 941 form for last year also, if this is something that applies to you, but only for the period back to March 12th. So you're basically talking about last 2.5 weeks of March would be the only part of that quarter that you would really be able to take the benefit. But, hey, if it means more, funding, then go for it, Okay. And so as I mentioned before, the coordination provision is that even though the time period has now been cleared so that we can do both, you can't use the same wages for the ERC that were counted as payroll costs for the purposes of determining the amount of your loan forgiveness. Okay. So you would need to really be doing some strategic planning and analysis, really, to generate the maximum benefits. Some of the planning may not, some of us who have not yet completed our forgiveness applications have a little bit more wiggle room here, because now we can sort of sit down with all of our information and say what makes the most sense. We have an opportunity, for example, to maximize the amount of non-payroll costs, whereas that might not have been so much of a consideration before. Well, now it is. So we have some planning opportunities that some of the folks who have already applied for and or received forgiveness may not have. But even if you have applied for or received forgiveness, there's still opportunity here. So as I think you're probably aware, because again, we were basing forgiveness on anywhere between an 8 and a 24-week period within the year. And clearly we have payroll costs, which again, don't forget, include health insurance and, in other periods besides the 8 to 24-week period that we use for forgiveness. So there's benefit here for everybody. And again, clarifying what counts as wages. Smaller eligible organizations, which we've established, includes us, and there's the stats that are there, can claim a credit for any wages paid to employees. The difference there is that for larger employers or eligible organizations, it only applies to wages paid to employees who could not provide services. But that limitation doesn't apply to us. We can claim a credit for any wages paid to our employees. And as I noted and bolded here in this particular section, qualified healthcare expenses count as wages. So we can include those. So here's, sort of a kind of a summary sheet, of the prior law sort of side by side with the new law as it applies to last year, 2020, and as it also applied to this year, 2021. So again, just to reinforce, the interplay with the PPP loan has gone from being mutually exclusive to now being available, on both of them being available, but what they call double dipping, the same wages, is not allowed. The maximum creditable wages per employee changed. And again, this is a really important change. And under the prior law, one of the things that made it less beneficial for us to claim it than the PPP loan is that it was the maximum creditable wages were limited to $10,000 per year. Okay. And it's still $10,000 per year under the new law for 2020, but in 2021, it's gone to $10,000 per quarter. Okay, so that's $10,000 per quarter per employee in 2021, $10,000 per year per employee in 2020. The maximum credit also got increased. It was 50% of eligible wages, so up to $5,000 credit per employee in 2020. In 2021, it's now 70% of eligible wages. So, because that's on a quarterly basis now, it's 70% of 10,000 per quarter, or $28,000 total credit per employee per year. That's the maximum. So there's some significant opportunity here for us to be able to get some credit against the payroll taxes. And again, the threshold to be considered a large employer was increased from 100 full-time employees to 500 full-time employees. And if I thought there was anybody who had more than 100, I'd go into what a full-time employee needs, but we don't even come close. So we really don't need to worry about that. And then finally, kind of moving through sort of the strategy and the steps, that we need to look at in light of this new law. The first one, and I reemphasize this on every single meeting, and I probably will continue to as people move through, and I'm really kind of getting sure that people are applying for and getting their, forgiveness on their first round loans. Make sure you clearly understand the options you have for your covered period and how they impact your loan forgiveness application deadline. Okay, so I put in a quote here that comes straight off of the SBA website, which I've linked. If you don't apply for forgiveness within 10 months after the last day of your covered period, then your PPP loan payments are no longer deferred and borrowers will begin making loan payments to their lenders. So that is the point at which, and it does say that's an application deadline. Okay, it doesn't mean you have to have been forgiven. It means you have to have applied within 10 months after the last day of your covered period. If you don't do that, then your loan is now a loan and can't be changed into a grant. And so to give an example, I used some of my own dates. The date of deposit of our PPP loan was May 4th of 2020. So the end of an 8-week period, because, again, remembering back now that with the changes in the CARES Act, we now have a choice, a complete choice of period. It doesn't have to be 8 weeks. It doesn't have to be 24 weeks. It can be anywhere in the middle, but it's got to be somewhere in that range. So for me, the beginning, the end of the 8-week period, which would be the earliest application deadline, would be April 28th, so the 28th of this month. If I decided that that I wanted to wait all the way to the end of a 24-week period, that would be October 18th of 2020. So my application deadline would then be August 28th of 2021. So I can choose any time between April 28th and August 28th as my deadline. I just have to remember it needs to coincide with what I'm claiming my covered period is. I could have a 10-week period. I could have a 12-week period. I could, I have choice, and that will depend for me on, first and foremost, the period of time I need to make my, my required payroll costs, as well as, non-payroll costs, to get complete forgiveness. And now, given this, it will also, depend upon how I balance that with how I want to coordinate it with the employee retention credit, if I were to apply for it. And so that's really, that's the first step in figuring out. So then, John Ager posted in the chat that they received full forgiveness for the 2020 loan using the 8-week period. So then at $10,000 per employee per year for 2020, how much of the $10,000 per employee might we claim for 2020? What you would need to do, John, is again, take a look at the actual wages that you used to achieve forgiveness, and understand that you cannot use those. Okay, and that goes for the healthcare costs as well. But for any of the, whatever that 8-week period was, go after that 8-week period and see, what your payroll costs were after that 8-week period. And as well as your healthcare costs. Now, pension costs don't count, but healthcare does. So, you can just go beyond your 8-week period in 2020. And again, you'll need to kind of be looking at this on a quarter by quarter basis as you amend your payroll tax return, and use up, if for some of your employees, you may be using up all of their wages, between then and the end of the year. But for some of them, like your priest, I'm sure that they would, use up the $10,000 probably within a quarter. And so that's really how you determine that. Does that answer your question? You could feel free to unmute yourself
Yeah.
if you want.
So I think so. I mean, because our payroll, we only have basically have four full-time employees. And so, an 8-week period is only a small fraction of the year. And so we're, at least, and I think our sexton's at 40 and our secretary's at 60. So we got plenty of payroll outside of the, beyond the what we used for the 8-week period. So we can, what I'm hearing is we can claim that 10,000 per year per person, as long as it's above what we claim for the PPP loan.
That's correct.
All right.
You're absolutely right about that. Yep. And Amanda, I think that probably answers your question too, right?
Yes. Yeah, because like I said, for ours, I want to say our forgiveness period ended around the end of June. So basically, I'm looking at it as I can start calculating with Q3.
Yep.
Over what I can take for the 10,000 per year for 2020.
Yep.
Yep.
Sounds good. I think we're getting it. By Jove, I think you've got it. So here's so moving on, like once you understand that timing, and again, for those of us who haven't applied yet, it's, we have a little bit more flexibility because we can actually go through these steps and then determine what we want our period to be, based on what maximizes the credit for us. So that's why, I had that step number 2, if possible, and again, understanding what your deadlines are. If it's possible, hold off on the forgiveness application until you have a chance to go through these calculations, and try to get the maximum benefit from both. And, for some of us, that might not take too much. We might be able to actually, especially in 2020, where the limitation is $10,000 per employee per year. If you've already determined what you think your covered period is going to be, just look beyond your covered period and see if you can get up to that $10,000 worth of wages or qualified wages, which again includes healthcare, per employee, just outside what you already thought your covered period was going to be. And if that's the case for 2020, then you've already got it. You don't have to worry about it. And you can just go ahead with what you plan to do, but it's worthwhile, to go through these steps and figure it out. So the next step would be to calculate your, qualified wages, including healthcare costs. And then, calculate, if you haven't already, which I hope most of you have. So you would just be comparing with qualified wages for PPP forgiveness. And then also, and this is important for those of us who haven't yet applied for forgiveness, it may make a difference in what non-payroll costs you decide to include now that you may need more payroll costs for the ERC, if it makes a difference for you. And this may come into play more in 2021. So this would be applicable to all of us, whether you have a second round PPP loan, PPP loan or not, actually, if you do have a second, round PPP loan, if you don't have one, you would just be looking at an employee tax retention credit anyway. But anyway, if for 2021, since the limits are so much higher, now it's $10,000 per employee per quarter. It may make more of a difference, how much non-payroll costs you have to apply towards PPP forgiveness, so that you can maximize the amount of payroll that you would have to use for the employee retention credit. So that may be more of an issue in 2021, actually, than it was in 2020. But that's a step that you would take, is to maximize the amount of non-payroll costs that you use for your PPP forgiveness, understanding that you still have to be over that 60% threshold, if you remember, for the PPP forgiveness. You don't want to jeopardize that. So you do need to make sure that your payroll costs are at least 60% of the cost you're using for PPP forgiveness. But to the extent that you can, make it, as little above 60% as possible, then it could benefit you on the ERC side. And then, as I mentioned, to the extent that payroll costs and or healthcare expenses are not used in any calendar quarter for PPP forgiveness, you can use them to calculate an employee retention credit for that quarter. You can implement the ERC by retroactively amending 941 forms for any prior quarter for which you qualify, and using any credit on 941 forms for future quarters in which you qualify. So if you make an amendment to your 941 form and you come up with a credit, well, then you can apply that credit towards the future 941. And again, at the end of the day, or I should say at the end of the year, if you have a net credit on your 941 form, this is a refundable credit. So you should, you would be able to actually have that amount refunded. And as we noted, you're going to need to coordinate and consult with your payroll company once you've done the calculations and you decide which way that you want to go. So you're going to need to have the numbers in front of you to talk about how you want to amend your 941 forms. Once you've got that, then you can sit with your, payroll company representative and actually go through the logistics of amending the forms. So that's basically that final step. And so I see your note in there, John. I didn't understand 2021 to be any different than 2020 as far as forgiveness was concerned regarding non-payroll costs. As a matter of fact, I thought they actually added a couple of categories to non-payroll costs and expanded that. So what I can do is, I'll just, double check that. I'm pretty sure that's right, that they actually expanded some of the categories. Charles, do you happen to know off the top of your head?
Not specifically, Phyllis. I mean, it seemed like it, but I don't give you an exact quote on it. I didn't get that deep into it.
I did, but I slept since then, so it's not forefront in my mind right now. But I'm pretty sure that they did actually expand that. You're correct, John. Payroll is used as the basis for the amount of the loan, or your payroll costs, which obviously include healthcare, pension, all of the stuff and that was in 2020 as well. When we actually calculated the amount of the loan for which the maximum amount of the loan for which you would qualify, that was only based on payroll costs, which included your, salaries, wages, healthcare, pension, those kinds of things. But when it comes to forgiveness, non-payroll costs, as far as I understand, are still, the same costs are still available, and they've even expanded it to a couple of different categories. If I'm wrong about that, I will absolutely let everybody know. And I will try to also get some information out that if I'm right about the fact that they've expanded the categories of non-payroll costs, I'll try to get some information out about what those were as well. And then last but not least, I just have my, the slide is just my sources and my resources. IRS Notice 2021-20, that's just for your information. It's 102 pages long. And it starts out by quoting a lot of the act itself, or referencing a lot of the pieces of the act. Those of us who are familiar with tax research know that's always the way they start. They always refer back to the acts that that they're quoting from. And so the part of the notice that's actually pretty helpful is the frequently asked questions. They start on page 17 of the notice. And as I referenced in my prior slide, the one part about it that I really felt I just wanted to dig into a little bit more had to do with that part about making sure that we can qualify as partially suspended. And those frequently asked questions that deal with that are most particularly questions 11 and questions 8 and questions 11 and 18. And I did reference that on my prior slide. But you can go in there and take a look. IRS Notice 2021-23 is a little bit shorter. I think it's only about maybe 12 or 14 pages long, and it just kind of amplifies on basically saying that the, talking about how the credit is being extended into 2021. All the way to the end of 2021, and there will yet be some further guidance, I'm sure, in a subsequent notice about, what if there are any particular changes to any of this. We haven't been made aware of any significant changes, so there may be some tweaks. Let's hope they don't do anything major retroactively again, because it's just a lot of work going backwards. And then the two accounting firm, resources that I used, because I thought they were just, some from the ones that I read, they were some of the most easily understandable. So those were the ones that I chose. There are many more. So John was asking about how do you calculate the credit? The calculation of the credit is basically, it's for 20, if you're going back into 2020, it's 50% of the qualified wages. So once you figure out what the qualified wages are, so basically there are any wages which were not included for PPP forgiveness purposes, and you could also include healthcare costs in any particular quarter. Once you come to that for each employee, it's 50% of that amount. It's that simple. For 2021, it goes now, you're talking $10,000 limitation per calendar quarter rather than calendar year. So I guess I probably should have mentioned that for 2020, if you go into whichever the first quarter that you decide that you can use based on your PPP experience, let's say for argument's sake, it's the third quarter of 2020. You take a look at everybody's qualified wages for that particular quarter, including healthcare costs. And you take 50% of that amount for every single person. And that's your credit for that quarter. Okay?
Does that include SECA and housing?
For a priest, it would. If they're getting a cash housing allowance, yes.
But we had the problem that the bank never let us use the housing in 2020. You're
talking about PPP. That's totally different than the credit.
Right, but if the housing wasn't included in the PPP, then can I include it in the ERC?
Sure.
Okay.
Yeah, and I'd actually even have to take a look. There's a chance you probably could, I would say the very strong chance that you would be able to include the value of church provided housing as well, for those of you who are providing a rectory and not actually paying a cash housing allowance.
I found a blog that said cash housing allowance counts towards payroll. So our bank gave us a little bit of a hard time for the second application. They deducted the housing, and I went online and found two blogs and said, hey, these two blogs say housing is legit, and they gave us more money. And we used housing to apply for forgiveness as well last year.
Yeah, for some reason, some of the banks have been sticky that way, even though the guidelines, as you saw, the blogs usually come from when the accounting firms or whoever you're looking at are analyzing, the notices, the regulations, as well as the law itself. And, it seemed to be clarified fairly early on. I remember right around this time, probably, or a little later last year, when we were dealing with the initial act, the CARES Act. I remember that they clarified that pretty quickly, and I'm not sure why some of the banks we're still really sticky about that. But I have had, more than a couple of times where, folks have kind of contacted me offline, outside of our meetings and said, hey, this is what my bank is telling me. And I was always encouraging them, with some of that same information to try to push back at the bank and say, no, this is allowed. And in most cases, I was hearing reports back that they were successful. Sally, you had an issue with that, didn't you?
I did, yes. We were not allowed to use our rector's salary in the beginning, nor we have a 1099 employee.
Right.
And then they came back and said, yes, when I got to a third or fourth contact in the bank, they came back and said, yes, we could use his salary. And then they, for 2021, they added in benefits and housing.
Okay. So it sounds like they finally got it straightened out.
Yes.
Yeah, thanks. Yeah, and Greg was saying he had to push back at TD on housing, pension, and medical. So it's just kind of an indication, I think, that even some of the banks have not been, really clear about this. And I'm glad that people are standing up for themselves and being advocates, because you've got the information right, so you deserve to get, the maximum benefit out of this that you can. So Colleen was asking first, where specifically will the slides be on the website? They will be, again, in that COVID-19 financial information section. Before we get off, actually, I guess I could probably stop sharing this screen and see if I can pull that up really quickly. Let's see. Okay, so the easiest way to get to that is if you go to, where the heck is it? Oh, here we go. So here's the diocesan website under the COVID-19 resources. Just cut right to the finance info, and it will take you there. The bi-weekly seminars that we have been doing, which will be happening actually again this Tuesday and Wednesday, they continue on stewardship, stability, and sustainability. They appear first, and then underneath those is some of the financial information that first came out of the PPP program. And so I will probably, since this is a different category, be putting that like in a section right above all of our PPP stuff, since the PPP stuff's, most of us have that pretty much down already. So I'll be creating a new section up here, or I'll have them create a new section that just is specific to the employee retention credit. So that's where that will be living. And then Colleen was also asking just to confirm the limitations of 10,000 per year for 2020 and 10,000 per quarter for 2021 is per employee. Yes, that is correct. $10,000 per employee, and then per year in 2020 and per quarter in 2021. So that's all that I had for today. That's a lot of information, so I think that's probably enough. Are there any other questions, that anybody has? Yeah, Meredith.
I'm having a difficult time with my first PPP loan, and I need some advice. I was contacted by the bank that there were some discrepancies in the application, and I've never been able to get a hold of the gentleman. And when I finally did coordinate with him, he said he no longer had my file because the second monies had come in and they were putting anything that was discrepancies on the first go round to like the back burner. So I would like to apply for forgiveness, but I don't know what I did in the application process that was wrong. And I was wondering, anybody else experienced something like this? Or have you heard of anybody else experiencing anything like this?
No, I haven't. I think that, you're with TD.
No, PNC.
PNC, yeah.
And we took
okay.
the second one through PNC as well.
Okay. Yeah, I mean, I could understand, because of the overlapping periods, and again, all of the changes that have been going on while the banks are trying to manage these processes, that they are probably a bit constrained in their capacity to be able to deal with it all at once. What I would say is, maybe just to give them a little bit more time, or, you might even just ask the person, if he doesn't have your file anymore, can he direct you to whoever does?
I actually, when I took the second loan out, we didn't have the number from them. So I reached out to him and left a voice message on a Saturday, and he called me back and looked up the loan number for us, because we needed that in order to continue.
Right.
To even apply for the second loan. He just said, not to worry about it, that they would there would be an email coming to me.
Okay.
So we got the money on the 15th. So we would be due to do that somewhere around August, right? That's your deadline was 8/28. You got the money on May 4th. We received the money on May 15th. I'm just worried about, I'm going to definitely be notified when I have to apply for forgiveness, correct?
Well, you have applied for forgiveness, if I'm understanding you correctly. I thought you said there were discrepancies.
In my loan application process, I haven't even applied for forgiveness yet. So he's telling me that there were problems with my application, even though I've had the money since the 15th of May.
There were problems with your application for the loan?
Yeah, I'll forward you the message. It's very confusing. And since I'm no longer treasurer, but I am responsible for that first loan because I was treasurer, I have concern.
Well, if you've got the money, I'd say that's a him problem. Because again, if there were discrepancies in your application, but they gave you the loan anyway, then I would wait. That's,
Okay. All right.
It's not like they're, I mean, for them to say, what would they do? Say they're going to take the money back?
I just didn't understand anything that I got from this gentleman, but,
Yeah. So, and I also would not let that stop you from applying for forgiveness. If you want to apply forgiveness, you go right ahead.
Okay.
If their portal is open and you've got the documentation that you need, and you guys are ready to apply for forgiveness, I'd go ahead and do it. I wouldn't wait. So, and you're also applying, you're also applying for a second loan?
We did, and we received that monies too.
Okay. Yeah. So if you're ready to go ahead and apply for forgiveness for your first one, I'd say go ahead and do it. And then, chances are maybe there's just some documentation or something that they think they need that they didn't get. And they're just going to ask you to provide it. If he's telling you not to worry about that, don't worry about it. Wait until you get the email, and then figure it out from there. All righty.
Thank you.
John.
You've outlined the requirements for 2020 pretty clearly. In 2021, if one is optimistic and says by the fourth quarter we're going to be fully opened again, what's going to be the cutoff for when we can apply for ERC?
Well, I mean, basically ERC operates on a quarter by quarter basis.
Right, but like I say, there was reduction of activity and reduction of income. Suppose those all go back